Short selling. Short selling is a trading strategy where an investor sells a stock they do not own, with the intention of buying it back later at a lower price. It's like betting against a stock, believing its price will drop. To short sell, the trader borrows shares from a broker and immediately sells them on the market at the current price. Later, if the stock price falls as expected, the trader buys back the same number of shares at the lower price, returns them to the broker, and pockets the difference as profit. However, short selling comes with significant risks. If the stock price rises instead of falling, the trader faces potentially unlimited losses, as they must buy back the shares at the higher price. This makes short selling a strategy primarily used by experienced investors who are adept at assessing market conditions and risks. This trading technique is often scrutinized and blamed for market volatility, yet it also plays an important role in the market by providing liquidity and helping to correct overvalued stock prices. It's a complex, high-risk strategy that requires a deep understanding of market dynamics and strong risk management practices. P/E ratio, price-to-earnings ratio. The P/E ratio, or price-to-earnings ratio, is a widely used tool to gauge the valuation of a company's stock. It compares the current price of the stock to the company's earnings per share, EPS. Essentially, this metric tells you how much investors are willing to pay for each dollar of earnings. A higher P/E ratio might indicate that the stock is overvalued, or investors expect high growth rates in the future. Conversely, a lower P/E ratio may suggest that the stock is undervalued or the company is experiencing difficulties. For example, if a company's stock is trading at $100 and the earnings per share for the year is $5, then the P/E ratio is 20. This means investors are paying $20 for every $1 of earnings, which can be compared to other companies in the same industry or the market as a whole to determine relative valuation. The P/E ratio helps investors analyze if a stock price fairly reflects the earnings potential or if it's subject to market sentiment and speculation. However, it should be used in conjunction with other metrics and insights to make informed investment decisions, as it does not account for future growth or the company's debt levels.
Click subscribe to this channel to get more topics you love.
Blue chip stocks. Blue chip stocks are shares of large, well-established, and financially sound companies that have operated for many years. These companies have a reputation for quality, reliability, and the ability to operate profitably in both good and bad times. Typically, these stocks belong to market leaders and are often household names with stable earnings and regular dividend payments. Investing in blue-chip stocks is considered safer than other stocks because these companies are less volatile during market downturns and have a proven track of resilience. They are often the backbone of an investor's portfolio, providing steady growth and reliable dividends, which are particularly appealing to risk-averse investors and those seeking income through dividends. These stocks are not just a safe harbor in stormy markets but also engines of growth in a well-rounded portfolio, making them a favored choice for long-term investors. Day trading. Day trading involves buying and selling securities within the same trading day. Traders capitalize on small price movements and use leverage to increase their exposure. This trading style requires a significant amount of time, attention, and technical analysis to make profitable trades. Day traders aim to end the day with no open positions, thereby avoiding the risk of significant price changes overnight. This type of trading is not for everyone. It demands quick decision-making, intense focus, and a deep understanding of market mechanisms. While day trading can be profitable, it carries substantial risks, particularly financial stress and the potential for large losses due to the high use of leverage and the volatile nature of day trading activities. Futures. Futures are standardized contracts to buy or sell a specific quantity of a commodity or financial asset at a predetermined price at a specified time in the future. These contracts are traded on futures exchanges and are used by investors to hedge against price changes or speculate on market movements. The assets involved can range from agricultural commodities like wheat and corn to financial instruments like bonds and currencies. Futures contracts detail the quality and quantity of the underlying asset. They are legally binding and include obligations for both the buyer and the seller. Traders use futures not only to hedge against price risks but also as a portfolio diversification tool. However, due to their complexity and leverage, futures are recommended for experienced investors. Options. Options are contracts giving the buyer the right, but not the obligation, to buy, in the case of a call option, or sell, in the case of a put option, an underlying asset at a specified strike price before a certain date. Each option contract has a buyer and a seller. The buyer of an option pays a premium for the right to decide whether to execute the contract's terms, while the seller earns the premium and must fulfill the contract if the buyer chooses to execute. Options are versatile instruments that can be used for hedging risks, speculating on future price movements, generating income, and improving portfolio performance. However, they require a good understanding of various factors, including volatility, time decay, and how they interact with the market dynamics. Bid. In the stock market, the bid represents the highest price a buyer is willing to pay for a stock. It's one half of a very important conversation in the trading world. When you look at stock prices, you're essentially seeing a series of negotiations between potential buyers and sellers. The bid price is crucial because it sets the floor for the current value of a stock. If you're selling a stock, the bid price is the best you can expect to receive if you sold immediately. The presence of a high or competitive bid price indicates a strong demand for the stock. Conversely, a low bid price suggests less interest. This price is constantly changing as new buyers enter the market and others adjust their willingness to pay based on market conditions. For traders and investors, understanding the bid price helps in making informed decisions on when to sell a stock to maximize returns or minimize losses. Ask. The ask price in stock trading is the lowest price a seller is willing to accept to sell their stock. It's the other side of the bid price and completes the basic framework of stock market transactions. While the bid price is what buyers are willing to pay, the ask price is what sellers are willing to accept. The ask price is always higher than the bid price, representing the seller's hope to sell at a slightly higher price to make a profit. Like the bid, the ask is dynamic and can fluctuate based on how many shares are being offered and the current market demand. A lower ask price may indicate a seller's urgency to sell, which can happen in a market downturn or if the seller predicts a decline in stock value. Conversely, a higher ask shows confidence in the stock's value or fewer sellers in the market. For buyers, understanding the ask price is key to determining when to buy a stock to ensure a good deal based on market trends. Spread. The spread in stock during is the difference between the bid price and the ask price of a security. It's a critical indicator of the liquidity and volatility of a stock. A narrower spread often indicates a more liquid market, where there are many buyers and sellers, and transactions can occur smoothly without a significant impact on the stock's price. On the other hand, a wider spread can indicate less liquidity, higher volatility, or both, possibly making it harder to execute large orders without affecting the market price. Traders look at the spread to gauge the market sentiment and the cost involved in trading a stock. A wider spread can also mean higher trading costs, as a buyer must pay more above the market price, and a seller receives less below the market price. Understanding spreads is crucial for both day traders and long-term investors as it affects the timing and pricing of trades. Market order. A market order is a directive to buy or sell a security immediately at the best available current price. It is the simplest and most common type of order in the stock market. When you place a market order, you are prioritizing speed over price, meaning you are willing to accept the best price currently available in the market, regardless of what that price may be. Market orders are typically executed very quickly, which is beneficial in fast-moving market environments where securing a position is more critical than getting a slight price advantage. However, the downside is that in a volatile market, the execution price may differ significantly from the last traded price, especially for stocks with lower trading volumes or wider spreads. This makes market orders ideal for highly liquid stocks where the spread is narrow, ensuring that the execution price will not stray too far from the expected price. Limit order. A limit order is a type of stock market order where you specify the exact price at which you are willing to buy or sell a stock. Unlike a market order, where you accept the current best price, a limit order only executes if the stock reaches the price you've set or better. This gives you control over the price, although it does not guarantee the order will be executed, especially if the stock does not reach your specified price. Limit orders are particularly useful in managing risk and securing a desired entry or exit point without constant market monitoring. They help in avoiding purchasing at a higher price or selling at a lower price than intended. For volatile stocks, limit orders can protect against sudden spikes or drops in price. However, the trade-off is that you might miss the opportunity to trade if the stock never hits your limit price. Stop-loss order. A stop-loss order is a strategic order used to limit a potential loss on a stock position. It automatically triggers a sale if the stock falls to a certain price, effectively stopping further losses. It's a crucial tool in risk management for both seasoned investors and new traders. By setting a stop-loss order, you decide the maximum amount you are willing to lose on a position. If the stock price hits this stop price, the order becomes a market order and sells at the next available price, minimizing potential losses in a declining market. However, one risk with stop-loss orders is that in a very volatile market, the stock may briefly dip to the stop price and trigger a sale, only to rebound shortly after. This can result in an unintended sale at a loss, missing out on potential gains if the stock's price recovers. Stop-loss orders are especially beneficial in helping traders manage their emotions by setting loss limits in advance, preventing panic-driven decisions during market downturns. They are a fundamental component of disciplined trading strategies, ensuring that traders can protect their capital and live to trade another day despite unfavorable market movements. Dividend yield. Dividend yield is a financial metric that tells investors how much a company pays out in dividends each year relative to its share price. It's expressed as a percentage and is particularly important for those who seek a steady income from their investments, such as retirees. The formula for dividend yield is, dividend yield equals, annual dividends per share / price per share, x 100%. Here's why it matters. A higher dividend yield suggests that a company is returning a significant amount of cash to shareholders relative to its stock price, which can be appealing if you're looking for income. However, it's crucial not to view high yield in isolation. Sometimes a high yield can be the result of a falling stock price, which might indicate underlying problems in the company, such as declining profits or fundamental challenges in its business model. On the other hand, a low dividend yield doesn't necessarily mean a poor investment. It might indicate that the company is reinvesting profits into growth projects that could potentially lead to higher stock prices in the future. Thus, while dividend yield is a useful indicator for income-focused investors, it should be considered alongside other factors to understand the full investment picture. Capital gain. Capital gain is the increase in value of a capital asset, like a stock, bond, or real estate, that makes it worth more than the purchase price. The gain is not realized until the asset is sold. This distinction between realization and unrealization is crucial because it impacts when you are taxed and how much control you have over your tax liabilities. For example, if you buy a stock at $100 and it rises to $150, your capital gain is $50. However, you won't owe taxes on this gain until you sell the stock. This system allows investors to strategize around when they want to incur tax liabilities by choosing when to sell assets. Capital gains are categorized as short-term or long-term. This is important because the two are taxed differently. In many jurisdictions, long-term gains, on assets held for more than a year, are taxed at a lower rate than short-term gains, providing an incentive for investors to hold on to investments longer. Understanding capital gains is vital for making informed investment decisions and for effective tax planning. It can influence everything from the choice of investment to the timing of when to buy or sell, making it a fundamental concept in the world of investing. Return on investment, ROI. Return on investment, ROI, is a versatile and straightforward metric used to measure the efficiency of an investment. It calculates the percentage return on a particular investment relative to its cost. To put it simply, ROI tells you what you get back for what you put in. The formula for ROI is ROI equals financial value, initial investment, x 100%. ROI is widely used because it can be applied to a wide range of contexts, from finance to marketing, and allows for direct efficiency comparisons between different investments. This makes it an essential tool for both business managers and individual investors when deciding where to allocate resources. However, ROI has its limitations. It doesn't account for the time value of money, which is a significant factor especially for long-term investments. More complex measures like net present value, NPV, and internal rate of return, IRR, are sometimes used to provide a more nuanced view by incorporating this aspect. Despite these limitations, ROI remains a popular and powerful tool due to its simplicity and the immediate understanding it offers regarding the effectiveness of an investment. It helps investors quickly gauge the success of their investment choices and decide how to proceed in managing their portfolios.